Welcome to the third and final part of our guide to the RDR, the Retail Distribution Review. Last time we looked at what the shake-up in financial services here in the UK will mean for you, the consumer. But what about the impact on the industry as a whole?
It's going to be a big change for the advisor community because now they're going to have to be very much clearer about what services they offer to their consumers, what they're paying for, what is the value in getting advice.
Early estimates are that potentially about 1 in 10 advisors are going to leave the industry almost overnight as a result of RDR. In essence, what's happening is that advisors are no longer going to be able to gain commission from items that they sell to individuals. Instead, they will be gaining an upfront payment, a fee for their financial advice. Now, that may not seem a massive deal. However, the whole industry has been predicated, or a large part of the industry has been predicated on the earning of commission for many years. So this is a fundamental change. In addition, advisors are going to have to achieve higher levels of qualification in order that they can produce the best quality for their clients.
Others say predictions of a mass exit from the industry are overblown.
Ever since the Financial Services Act came in the 1980s, people have been saying that financial advisors are very adaptable, and the reality is the public always needs financial advice, good financial advice. So I think a lot of financial advisors will change the way they do business. A lot of them will go more directly to the consumer through websites, for example. Historically, they've relied on referrals from one client to another. So I think the nature of the way financial advisors do their job will change. I think a small number will go out of the industry in the first couple of years, but you are beginning to see sort of newer, younger advisors coming into the market.
Another concern is that post-RDR, many advisors will focus purely on advising wealthy clients. Deloitte has estimated the changes will create 5.5 million advice orphans who'll either be unable or unwilling to pay advisor charges.
A lot of financial advisors are moving upwards, are moving to high net worth. It does create this sort of wasteland in the middle. And then below that, in effect, you'll have things like the money advice service, which is coming online and obviously has a lot of spend. And also you have people dealing with the internet and these money management programs from banks and what have you. I do wonder whether or not for very long, this supposed advice orphans will be truly on their own, because that's a huge number of people. They're middle Britain, in effect. And I can't really see financial advisors forgoing that business long term.
It's also expected that many people will try to avoid paying upfront fees and manage without an advisor.
We're already seeing consumers use the internet a lot more now to get information about products and services and investment opportunities before they go to get advice. So they're seeking advice as better informed consumers. But for sure, there will be some people who decide that they don't want to pay their advisor for advice or for financial planning services, and so they will want to be able to transact directly with some of the discount platforms online.
Much more worrying from a national perspective is that some will choose to invest less, or indeed not at all.
I think there's a real danger for the first couple of years after RDR that we'll see people saving less and perhaps either not spending the money at all or redirecting it into just consumer spending.
The RDR will certainly focus investors' minds on how much they're paying. Poor performing funds, especially those with higher charges, may well close down.
Some of these companies that had hundreds of different styles of funds, they will consolidate those funds and merge a lot together. So some might have 20 million in, 100 million, 300 million, up to £1 billion plus. And you'll probably see a lot of the companies merging or being taken over.
Of course, the original intention behind the Retail Distribution Review was to restore the public's faith in the financial services industry. That faith was further dented in the credit crunch and the financial crisis that followed. Realistically, the industry has a long way to go towards rebuilding its reputation.
I think that sort of the financial services industry in general are held in very low esteem. They're seen to be sort of major contributors to the world financial crisis. If this new review can help to remedy that, then it can be no bad thing. But I suspect it'll take an awful lot more and a lot more time.
So, although generally the Retail Distribution Review is a positive development for investors, it does pose new questions and present new dangers. We at Sensible Investing TV want to hear your views on the RDR and what it means for you and the industry, so keep those comments coming. You can follow us on Twitter and on Facebook, and why not join our LinkedIn group as well? Thank you for watching.